Hey everyone, it's Mark from TransCanada Wealth Management. Today I want to talk about 3 underused tax strategies in retirement. Now to be clear, these strategies are not for everyone, and before I even think about recommending these to clients, they need to meet certain thresholds. The first threshold is that they need to have a retirement plan in place that shows that they're going to be okay and that they're not going to run out of money based on their expense goals. Now, the second threshold is that if they want to leave money to their kids, that has already been factored into the retirement plan. The reason that I have these thresholds is because the 3 strategies that we're going to look at involve donating money to charity. I'm all for donating money, but you need to make sure that your own retirement is taken care of before you start giving your money away. The first strategy that we're going to examine involves withdrawing funds out of your registered account, so your RSP or RIF, tax-free. Gary hated paying taxes on his RSP withdrawals, so every year he would take what he withdrew and donate it to charity to offset his taxes. The problem that he had, though, was withholding taxes. Whenever you make a withdrawal from an RSP, a certain amount of withholding tax will need to be held up front. So Gary was withdrawing $30,000 per year, and based on this amount, 30% taxes would need to be held. So after paying the taxes, he was left with $21,000. So now he had to report income of $30,000 based on his withdrawal, and he only had $21,000 left to make a donation to charity, so that $9,000 difference was making him pay more tax than he needed to. This is where Gary can take advantage of Form T1213. On this form, he can make a request to the CRA to not have any tax withheld on his withdrawal because his intent is to donate the funds to charity. Once Gary's request is accepted, he can provide this form to his financial institution and they will not withhold tax on his $30,000 withdrawal. By using this strategy, Gary has $30,000 worth of income from the withdrawal, but then he has an offsetting donation of $30,000, which depending on the province you're in, basically nullifies any tax owing. It does take some time to get this form approved from CRA, so I wouldn't leave this strategy to the end of the year. The second strategy that's underused in retirement is donating securities to charity. Sarah lived in Manitoba and had an income of $100,000 per year. She wanted to make a one-time donation of $75,000 to a charity that was dear to her heart after her husband's passing. Her plan was to withdraw funds out of her non-registered account to make the donation. However, the issue that Sarah was facing is that she would be triggering a large capital gain. She had originally contributed $10,000 to her non-registered account, and it was now worth $75,000. So if she withdrew the entire amount, she would be triggering a capital gain of $65,000. Of this amount, half of it would need to be added to her tax return, and this would result in a tax bill of just over $13,000. Her $75,000 donation would leave her with a tax credit of $34,759, leaving her with tax savings of just over $21,000. Alternatively, Sarah could avoid paying tax altogether. Instead of selling her investments and triggering the capital gain, she could donate her investments directly to the charity instead. By doing this, she'd be donating $75,000 worth of investments, and she wouldn't be triggering any capital gains. This would leave her with net tax savings of over $34,000, putting her $13,000 ahead of her original strategy. The third strategy that's underused in retirement is to make donations while you're still alive. Alfred was 93 years old and had $40,000 of taxable income. He had $1 million in his savings, and his will indicated that his entire estate be donated to charity. Now, the problem with making charitable contributions as part of your will is that the tax credit can only be applied in your year of death and the previous tax year. So assuming that Alfred had an income of $40,000 in his year of death and the previous year as well, his $1 million donation to charity would only be able to offset about $80,000 worth of income. Alfred would have been better off making annual donations as he would have received the tax credit every year rather than on his final 2 tax returns. These tax savings could have allowed Alfred to give even more throughout his life. If you want to learn how to tax efficiently withdraw funds from a large RSP, check out this video.